Okay, let's dive into this. Have you ever really stopped to wonder why your bank treats you exactly the way it does? Well, today in this explainer, we are going to pull back the curtain and look at the hidden architecture of banking. We're going to map out exactly how a bank's treatment of you scales, how it completely transforms starting from $0 and going all the way up to $25 million. And what is absolutely fascinating about this, and honestly, maybe a little bit shocking when you really think about it, is that this treatment is based entirely on the numbers sitting next to your name in a database. It's like a giant invisible rulebook. So let's start right at the very bottom.
-$4. You know the feeling. You open your banking app on your phone, you see that little minus sign, and you just stare at it like it might magically disappear if you blink hard enough. But it doesn't. You overdrafted by exactly $4. And it wasn't even something big. It was just a coffee subscription you simply forgot was scheduled to charge that morning. Now here's the kicker. The bank does not care that it was just $4. The bank only cares about the math, and the math simply says that you went under.
Phase 1. The penalty of being broke.
Let's walk through exactly how this cascades, because it happens so incredibly fast. It starts with that tiny $4 mistake. Instantly, an algorithm triggers a $35 bank fee. Think about that for a second. The fee is literally almost 10 times bigger than the mistake itself. Then, because your balance is now sitting even further in the negative, your rent payment fails the very next morning. Boom. Your landlord charges you a $75 late fee. Then your automatic phone bill bounces, adding another $25 penalty. So naturally, you panic. You try to call the bank to fix this, right? But you're just trapped, looping an endless automated hold music, eventually reaching someone who's just reading off a script telling you that fees absolutely cannot be reversed. Within a matter of hours, a tiny $4 oversight snowballs into a $200 deficit. It's growing in directions you never authorized, all because the bank is essentially charging you money for not having money.
And there is this absolutely fascinating psychological shift that happens between having a negative balance and finally scraping your way back up to a positive $200. When you're negative and you walk into a physical branch, the teller's face literally changes. You stop being a person and you start being a flag in their system. You're a category, you're basically just a risk score with shoes. You are a problem that needs to be managed. But then, let's say you pull that account back to positive $200. You might think things get better. Actually, scratch that, you aren't treated as a problem anymore. But you certainly aren't treated as a valued customer either. You just become utterly invisible. You're simply moved through the system like luggage on a conveyor belt, completely unseen.
Let's really break down the reality of existing at that $200 level. You're finally in the positive, right? But quietly, in the background, $12 to $15 maintenance fees start hitting your account every month. And why? Because the minimum balance to avoid those fees is $1,500, which, of course, you don't have. So you are essentially paying the bank a monthly subscription fee just to hold the money you barely have. And if a real emergency happens, say you get a blown tire on the highway, and you desperately apply for a credit card, the system doesn't offer you help. It offers you a secured card. They literally ask you for $300 of your own money to hold as collateral just so they can generously lend it back to you at 24% interest. At $200, the bank absolutely does not see you in their attention. You just exist as a tiny data point on their books.
Phase 2. Crossing the profit threshold. And this brilliantly illustrates the shift. As we discussed, at $200, you are essentially invisible and you don't even qualify for standard rates. But at $2,000, that is where the magic happens. Those quiet $15 maintenance fees suddenly and automatically vanish. The bank sees a consistent pattern now, like your direct deposit hitting from your job every 2 weeks, that reliably earns them money behind the scenes, so they stop directly taking yours. You suddenly get approved for a loan at a standard 11% because your internal status has flipped to profitable. And as we look ahead to the $15,000 mark, that exact same loan rate drops to 6.8%. The exact moment those pesky fees vanish and your credit becomes cheaper is simply the exact moment the system's math calculates you are less of a risk.
So, what does this all mean? The absolute crucial point to take away here is this. The bank doesn't care who you are. The bank cares what your account looks like. At $2,000, the exact same system that completely ignored you a month ago is now mailing you credit card offers with your name printed in fancy metallic ink. You start getting approved for small personal loans in 48 hours. Now make no mistake, you aren't deeply respected yet, and you definitely aren't receiving VIP treatment. But you are profitable. And because you are a reliable source of profit, the bank can now confidently sell things to you.
Now, let's step it up to the $15,000 tier and walk through what a typical day looks like at this level, because the contrast is wild. In the morning, you log into your app and realize your credit limit was just bumped from $4,000 to $9,500, completely unprompted. The bank just decided to give you more rope.
Then, by 9 a.m., your phone rings, and it's an actual human being. It's your newly assigned personal relationship banker calling just to introduce themselves and discuss your financial goals. And later in the afternoon, let's say a $32 fee accidentally hits your account because of a weird transfer glitch. You shoot off a quick email to that banker, and it is reversed instantly. No hold music, no reciting your mother's maiden name to a robot, no strict policy scripts. The very same fees that drained your account for years when you were broke are suddenly entirely optional.
It's important to realize that the bank wasn't intentionally being mean to you when you were broke, but indifference at scale looks exactly like cruelty. The system wasn't sitting in a boardroom maliciously targeting you back when you were at -$4. It was just entirely mathematically indifferent to your existence. At those lower tiers, you aren't a client they are investing in. You are simply a massive pool of capital that they are investing for.
Phase 3. Becoming a protected asset.
Okay, so at $80,000, everything levels up again. The bank officially labels you a preferred client. Now, when you walk into a physical branch, you do not stand in that same winding line you used to wait in when you had $200. You are warmly guided right past the rope line, straight back to a glass office. Your banker, let's call him David, magically remembers your birthday, and he asks how your sister in Chicago is doing. And listen, that is not an accident. It's training. The bank's internal software prompts him. They train their staff to remember these small, highly personal details because small details retain big accounts. You start getting unprompted $400,000 mortgage pre-approvals in the mail. And if you even hint that a competitor bank is offering you a slightly better interest rate, David is going to call you back within the hour with a custom counteroffer to keep you. The bank is now actively and aggressively defending you from competitors.
Think about the stark, literal contrast here. It's like two entirely different realities. At $200, you are waiting in physical lines, listening to 40 minutes of crackly automated hold music just to ultimately be told no by someone who doesn't know your name. But jump to $500,000, you don't even go to the bank anymore. The bank comes to you. The banker physically drives to your downtown office, hands you printed reports tucked into a nice leather folder. If a massive wire transfer freezes up for some reason, you don't panic. You make one phone call to a direct number, someone picks up on the second ring, and the problem is resolved in a single, calm conversation. At this level, money isn't a point of friction anymore. Money is just the table you're sitting at.
But there is a very subtle, yet incredibly powerful psychological shift happening here at the $500,000 mark. The banker sitting in your office isn't trying to sell you a fancy credit card anymore. You are receiving a consultation. And a consultation is very specifically something the bank wants you to need. Think about it. A financial product is just a one-off transaction. You buy it, it's done. But if they can successfully weave themselves into your long-term estate plans, your complicated tax structures, and your generational timelines, they secure your reliance for decades. Needing them is worth so much more over time than simply buying from them once.
Phase 4. When rules become negotiable. When you hit $5 million, you officially enter the world of private banking. Now, a lot of people often confuse wealth management with private banking, but understanding the distinction is absolutely everything. Wealth management is essentially just a service. Private banking, on the other hand, is a relationship. And relationships don't follow standard rules. They negotiate them. At this tier, you have a private banker who might manage fewer than 20 accounts in total. Their whole job is you. Your mortgage interest rate? It isn't pulled from some table published on a public website. It is negotiated behind closed doors in a room. Complex paperwork that takes a normal everyday customer 2 solid weeks of waiting to process gets completely handled and pushed through in 48 hours, simply because someone internally was told exactly whose account was on the line.
And then we reach the absolute peak, the $25 million reality. This is a whole different stratosphere. At $25 million, you do not apply for things. Things apply for you. High-yield, exclusive private investments are brought to your desk before they are even whispered about publicly. Deals are completely bespoke. There's no glossy brochure to hand you. There are just legal sentences drafted exclusively for you, completely tailored to your personal timeline and risk appetite. And honestly, perhaps most astonishingly of all, your specific relationship is a named line item in someone's annual performance review. There are literally 2 or 3 highly paid people inside that building whose entire careers partially depend on making sure they do not lose your specific account.
But the ultimate realization at $25 million is this. The real shift isn't just about having access to better perks. It is about influence. The bank doesn't just serve you anymore. The bank actually consults you. The chief investment officer might literally call you up and ask for your opinion on emerging markets. The head of private banking might fly out to your city, take you to a private dinner, and ask you what kinds of financial products they should build next. You are no longer just a customer sitting in a database. You have actively become a partner in shaping the institution itself.
Phase 5, the full circle resolution.
So, the crucial point we need to take away from all this is, I want you to think all the way back to that -$4 we started with. Right now, at this exact moment, someone else out there is staring at their phone screen, looking at that exact same minus sign. They are watching a brutal $35 fee hit their account for a $4 coffee mistake, and they are feeling utterly exhausted. They're listening to that exact same automated hold music looping for the third time, talking to a script that tells them there's no way to help.
And here is the profound final realization we have to face. The system isn't actually broken at all. It is working exactly the way it was meticulously built to work. The massive institution that is actively charging the broke person $35 just for not having enough money is the exact same institution that is flying its executives out on a private jet to consult the $25 million client. It's the same logo on the building. It's the same bank. It's the same fundamental system. The rules don't break. They just seamlessly adapt to the math.
Which leaves us with this final, really important thought to wrap up this explainer. You are the exact same human being, with the exact same inherent worth at -$4 as you are at $25 million. Your character hasn't changed. But the bank doesn't see a human. It sees a balance. The bank decides exactly who you are, what kind of respect you deserve, and what rules apply to you based entirely on what is sitting next to your name. So, next time you log in, take a real hard look at your own accounts. Think about the fees you are forced to pay, or maybe the perks you get to enjoy, and ask yourself one simple question. Who does your bank think you are?